Hi all. In the previous video we discussed about public revenue, one of the aspect of public finance. Today we are going to discuss about investment planning, that is one of the component of personal finance. So let us have a look what exactly is investment planning. Investment planning is the process of identifying financial goals and converting them through building a plan. Investment planning is the main component of financial planning. It begins with identification of goals and objectives. Then we need to match those goals with our available financial resources. Nowadays, there are many investment vehicles to invest in, most common being cash, equities, bonds, and property. So, according to the funds available, we can invest in these vehicles to obtain our goals and objectives. Let's have a look on objectives. Objectives of financial planning. First objective, generate income or capital gains. Through investments, one can earn regular returns by way of interest on savings. The individual can earn capital gains by selling the shares or funds for a higher value. Next comes enhance your future wealth. As the individual get additional revenue by investing in various schemes, it would increase the wealth of an individual. Strengthen your investment portfolio. One of the rules of investment is investing the funds to various schemes to balance the risk, which is also known as diversifying of risk. So, investment planning helps to strengthen the investment portfolio. Save on taxes. There are various investment plans which gives an opportunity to save tax. So, next comes creation of investment plan. So, how can we create a investment plan which will diversify the risk and maximize the return? So first, find when and how much you are saving. Before planning any investment, we should take into consideration what percentage of income we will be allocating for investment. Once it is done, we will move for the next step. Set your financial goals. The next step is to set the financial goals. Here we will decide for what purpose we are saving, like building house, child education, marriage, or for retirement. Analyze your risk-taking ability. Once the financial goals are set, next step is to analyze our risk-taking capacity. If we are ready to take high risk, we can invest in higher percentage of investment in stock market, or else we shall invest in lower risk investment like fixed deposit, recurring deposit, etc. Create savings portfolio. Once we analyze the risk-taking capacity, then we will check where we can invest, in which areas to invest like FD, RD, mutual fund, insurance, etc. Calculate your asset allocation. Once we have learned various instruments and created a portfolio, now we must decide the percentage of investment on various instruments. Know how to build your portfolio. Once the portfolio is set, we must learn to manage the portfolio so that we can diversify the risk and maximize the profit. Investment options. There are various investment options. I have picked some of the options. Fixed deposits. It is one of the common investment option. It is less risky and has a good rate of return and easy to liquidate. Recurring deposit. In this, the investment is done either monthly or quarterly, and it also gives similar rate of return as fixed deposit. This is beneficial for those individuals who are unable to deposit in a lump sum. PPF or Public Provident Fund. This is another option where we can start investing with rupees 500. This also gives good return, but the lock-in period is 5 years. NPS or National Pension Scheme. This scheme is mostly considered under retirement planning. The part of investment is reinvested after completing 60 years of age, and it comes with 10 years lock-in period. Insurance. Insurance is a protection plan, but there are various types of insurance policies which also comes with savings plan, money back plan, etc. We will learn more about insurance under insurance planning. Equity. The other option is to invest in equity shares. We can gain return either by dividend or by capital appreciation. This option is quite riskier than the traditional savings scheme. The investments in equity needs regular monitoring. Mutual funds. It is an option where we can diversify our risk. Under this, Fund manager will diversify risk by allocating the money into various stocks, which will balance the risk and gives regular returns like dividend and capital appreciation. Like recurring deposit under mutual fund, there is an option called SIP, Systematic Investment Plan, where we can invest on monthly basis. Gold. One of the traditional savings is buying gold. In our country, most of the households do savings in gold. Nowadays, we have an option to buy gold in papers as well. In other words, in order to reduce the risk of loss or theft of physical gold, now we have a paper gold or ETF where we can invest in gold without buying the physical gold and can be traded in the market similar to other company shares. Next comes real estate. One more option to invest is in real estate and it's a long-term investment. So, till we have seen the various options which are used in investment planning, we can have a video where we will be looking more about investment plans. And these are the sources from where I have picked some of the points. Thank you very much. Please like, share, and subscribe my channel. Thank you very much.